Hello everyone, welcome back to Stock Spy. Today we are taking a closer look at Himax Technologies, a small cap semiconductor stock which has been drawing attention after its recent earnings. So is it a hidden gem or a value trap? Let's find out. Himax Technologies is a fabulous semiconductor technology company headquarters in Taiwan. It designs and supplies display driver ICs, timing controllers, and image processing chips used in TVs, smartphones, cars, and even AR glasses. The company operates through two main divisions, driver ICs and non-driver products. So essentially, if you're looking at a screen, there is a good chance that Himax is behind it. The stock has been volatile. As of early October 2025, it trades around $9 per share, which is down from its 52-week high of $13, but still well above the lows of $5. The valuation looks modest with a market cap of $1.6 billion and a dividend yield hovering around 4%, which is a rare feature in the semiconductor space. Now looking at the numbers, in Q2 2025, they reported a revenue of $215 million, which is a 10% decline year over year. Net income fell to $16.5 million or 0.09 per share, which is compared to 0.17 last year. Gross margins held steady around 30%, but management guided for a 12 to 17% revenue decline in Q3 and even warned a potential quarterly loss. Market didn't take that well and shares dropped. Despite the short-term weaknesses, they have some interesting long-term drivers. First is the rise of automotive displays. More screen inside car means more display driver ICs. Himax already supplies chips for dashboard, infotainment systems and rear seat displays. Second, it's push to AR and AI vision technologies. They provide optical sensors and image chip that could power next-generation AR glasses and smart devices. This market is small now, but it's growing really fast. And the last, it's a diversification away from traditional smartphones and tablets, which could reduce the dependence on consumer cycles or smooth revenue over time. But it's all not smooth sailing. They are exposed to cyclical semiconductor demand, and global display shipments have slowed as electronic spending weakens. Its heavy reliance on few large panel manufacturers add concentration risk. The near-term guidance also suggests softness in customer electronics and pricing pressure in driver ICs. That could squeeze margins if recovery takes longer than expected. Finally, the competition in this field is intense. Companies like Novatech, Synaptic, and POE Technologies are all vying for the same market. Financially, they remain solid with low debt, steady cash generation. The company regularly returns cash to shareholders through dividends, which is a positive sign. At around $9 a share, the forward PE ratio sits in the low teens. If the semiconductor market rebounds in 2026, this could be a cheap buy as of now, but only if the earnings recover as expected. Analyst options on the other side are mixed. Some see them as undervalued and targeted price around $12 to $15, while the others expected a longer slump before the recovery. But most agree the key to unlocking growth will be its non-driver business, especially imaging and AI vision chips. To wrap it up, Himax Technologies is a solid but cyclical semiconductor play. Fundamentals are sound, dividend is appealing, and the new technology could drive future growth. But near-term headwinds remain strong. So if you're an investor comfortable with volatility and long-term hold, Himax might be worth considering in your watch list. That's it today on Himax. What do you think? Is it a hidden gem or a risky bet? Drop your thoughts in the comments. And thanks a lot for watching.